The sequence of events in January 2026 reveals an economic pattern that most participants misunderstand as chaotic when it's actually structural. Over the past week, President Trump threatened and then reversed European tariffs over Greenland within days, announced framework deals with ambiguous details, and then threatened Canada with 100% tariffs over a trade deal with China that he had previously endorsed. To the casual observer, this appears unstable. To a systemic analyst, it's a demonstration of how economic weapons become destabilizing forces in their own right, regardless of intent. We're not watching policy experimentation. We're watching the mechanics of financial system fragmentation play out in real time. The question isn't whether this approach creates winners and losers. The question is whether the economic structure can withstand the velocity of these shifts without triggering cascading failures across interconnected markets. Recent data from January 2026 suggests we're approaching the threshold where policy volatility itself becomes the primary source of risk. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. Consider the mechanics of what happened this week. 8 European nations were targeted with tariffs starting at 10% on February 1st, rising to 25% by June, over their resistance to U.S. acquisition of Greenland. Denmark, Norway, Sweden, France, Germany, the United Kingdom, the Netherlands, and Finland were all named. These aren't minor trading partners. Germany alone accounted for $236 billion in bilateral trade with the United States in 2024. The United Kingdom represented $147.7 billion. These are integrated supply chains built over decades, representing trillions in cumulative investment and millions of jobs across both continents. Then, after a meeting in Davos, Trump announced a framework deal with NATO Secretary General Mark Rutte and immediately suspended the tariffs. The details remain vague. Trump described it as addressing security and minerals and everything else related to Greenland and the Arctic region. When asked whether Denmark would continue exercising sovereignty over Greenland, Rutte said the issue didn't come up in the meeting. Denmark's prime minister stated her country will not negotiate sovereignty. NATO spokeswoman Alison Hart clarified that no compromise on sovereignty was proposed. Yet markets rallied on the announcement of this undefined framework, with investors breathing relief that tariffs were suspended. This reveals something critical about how modern markets function under policy uncertainty. Traders aren't evaluating the substance of agreements. They're evaluating the direction of threats. When threats decrease, prices rise. When threats increase, prices fall. The actual economic fundamentals become secondary to the political theater. This works until participants realize the theater isn't connected to underlying reality, at which point pricing mechanisms break down because there's no stable reference point. Within days, Trump threatened Canada with 100% tariffs if it proceeds with a trade deal with China. This came after he publicly stated just a week earlier that Canada signing a trade deal with China was exactly what Canadian Prime Minister Mark Carney should be doing. The reversal wasn't based on new information about the deal itself. It was based on geopolitical positioning and the perception that Canada might become a conduit for Chinese goods entering the U.S. market. Trump posted on Truth Social that if Carney thinks he can make Canada a drop-off port for China to send goods into the United States, he is sorely mistaken. This pattern matters because it reveals something fundamental about how modern economic systems break. The damage doesn't come primarily from the tariffs themselves, though those effects are substantial. The damage comes from the inability of economic actors to plan, invest, or allocate capital when the rules change faster than business cycles can adjust. A manufacturing facility requires years to plan, finance, construct, and bring to full production. A supply chain relationship requires investment in logistics, quality systems, and coordination mechanisms. These decisions can't be reversed weekly without enormous capital destruction. Throughout 2025, the Trump administration imposed tariffs using the International Emergency Economic Powers Act, claiming trade deficits and drug trafficking constituted national emergencies. This was unprecedented use of emergency authority. IEPA was enacted in 1977 and has been invoked 67 times for national emergencies, but never before to impose import tariffs. The closest historical precedent was President Nixon's imposition of tariffs in 1971 under the Trading with the Enemy Act, which IEPA amended. By January 2026, reported data indicates the average tariff rate on imports reached approximately 17%, compared to 2.3% at the end of 2024. This represents the highest tariff levels since the 1930s. The Tax Foundation estimates these tariffs will cost the average U.S. household $1,000 in 2025 and $1,300 in 2026. The Tax Policy Center projects approximately $1,200 per household in 2026 for median household income of approximately $75,000. An additional $2,100 in annual costs represents nearly 3% of gross income, or closer to 4% of after-tax income. But here's where the structural problem emerges. Businesses absorbed roughly 80% of tariff costs in 2025, according to JP Morgan analysis. They couldn't immediately pass costs to consumers without losing competitive position. So businesses absorbed costs through reduced margins, delayed investments, and slower hiring. They built inventory stockpiles in the first half of the year, anticipating higher future tariffs. Those stockpiles are now depleting. JP Morgan estimates that by 2026, the burden shift could reverse, with businesses passing through 80% of costs to consumers instead of absorbing them. This creates a lag effect where the price impact hits households in 2026, even if no new tariffs are added. Kyle Peacock, principal at Peacock Tariff Consulting, stated that many clients really didn't want to pass costs on, but now they're really having to. This creates a rolling wave of price increases hitting different sectors at different times throughout the year. The Yale Budget Lab calculates that tariffs through November 2025 will slow U.S. GDP growth by 0.5 percentage points in 2025 and 0.4 percentage points in 2026. U.S. trend growth is approximately 2% annually. Reducing that by 0.4 to 0.5 percentage points represents cutting growth by 20 to 25%. That's the difference between economic expansion that creates jobs and raises incomes versus stagnation that leaves people treading water. The unemployment rate is projected to end 2025 at 0.3 percentage points higher and 2026 at 0.6 percentage points higher, with payroll employment 490,000 lower by the end of 2025. That's nearly 500,000 jobs that won't exist compared to baseline projections. In the long run, the U.S. economy remains persistently 0.3% smaller, equivalent to approximately $90 billion annually in lost output. Over 20 years, that's $1.8 trillion in cumulative lost output. Manufacturing sees some expansion under tariffs, approximately 3% in the long run, according to Yale estimates. But advanced manufacturing, the high-value sectors involving semiconductors, aerospace, and precision instruments, actually declines by over 4%. The sophisticated manufacturing that generates high-wage jobs and technological advancement contracts, while lower-value manufacturing expands. Meanwhile, construction contracts by roughly 4%, agriculture declines by more than 1%, and mining and extraction decline by more than 2%. This isn't the story of protective tariffs bringing back manufacturing jobs in a net positive way. This describes an economy that becomes less productive, less innovative, and poorer in aggregate while certain narrow sectors expand. Penn Wharton budget model projects even starker outcomes. Under their analysis, Trump's tariff plan as of April 2025 would reduce GDP by approximately 8% and wages by 7% over time. A middle-income household faces a lifetime loss of roughly $58,000, For a household earning $75,000 annually, a $58,000 lifetime loss represents nearly a full year of current income that simply disappears from lifetime resources. These losses are approximately twice as large as those from a revenue equivalent corporate tax increase from 21 to 36%. Tariffs are more distortionary because they reduce openness, reduce competition, reduce access to inputs, and create rent-seeking behavior where businesses lobby for exemptions rather than competing on efficiency. The mechanism driving this damage isn't mysterious. Tariffs reduce the openness of the economy, including international capital flows. The United States runs persistent current account deficits, meaning it imports more than it exports. That deficit is financed by capital inflows. Foreign investors buy U.S. assets, including Treasury securities, corporate bonds, equities, and real estate. When tariffs reduce trade flows, they also reduce capital flows because the two are connected through balance of payments accounting. Reduced capital inflows mean domestic savers must fund a larger share of investment. Given the U.S. baseline debt path, which is increasing faster than GDP, this creates a problem. The federal government is borrowing enormous amounts. Corporate investment needs funding. Households want mortgages. All of this competes for a limited pool of domestic savings. Either bond prices fall and yields rise, or domestic capital investment prices fall, or both. This crowds out productive investment. The Economic Policy Uncertainty Index reached its highest point since the beginning of COVID-19 by late March 2025, doubling in value from early January. Baker, Bloom, and Davis methodology suggests this rise in uncertainty reduced investment by approximately 4.4% in 2025. Uncertainty operates as a tax on future activity. When businesses don't know what the tariff rate will be next month or which countries will be targeted next week, they default to caution. Investment decisions are irreversible in the short term, so businesses wait for clarity. But clarity never arrives because policy keeps shifting. Respondents to the Institute for Supply Management's November survey expressed elevated worry. One manager in electrical equipment said conditions were more challenging than during the coronavirus pandemic in terms of supply chain uncertainty. A respondent from the petroleum and coal industry noted that going into 2026, the company expects significant changes in cash flow and employee headcount, having sold off revenue-generating assets while offering voluntary severance packages. This brings us to the Supreme Court question hanging over the entire structure. Multiple federal courts have ruled that President Trump exceeded his authority under IEPA by imposing tariffs. The U.S. Court of International Trade ruled that IEPA tariffs were illegal because the triggering emergency bore no rational connection to the trade measures imposed. A Washington, D.C. district court went further, holding that IEPA doesn't authorize tariffs at all. The Supreme Court consolidated the cases and heard oral arguments in November 2025. A decision is expected in early 2026, potentially within weeks. JP Morgan estimates that IEPA measures account for roughly 61% of the year-to-date increase in U.S. tariffs, approximately $180 billion on an annualized basis. If the court declares these tariffs unlawful, the administration could lose authority to collect duties and might need to refund revenues already received, potentially around $100 billion collected in 2025. The administration would then need to pivot to alternative legal frameworks, likely Section 232 national security tariffs and Section 301 unfair trade practice tariffs. This legal uncertainty adds another layer of instability. Businesses that paid tariffs under IEPA authority might receive refunds, but they've already passed costs to customers or absorbed them in reduced margins. Importers who adjusted supply chains might find those adjustments were based on tariffs that get invalidated. There's no way to predict optimal strategy when the legal foundation underlying policy remains contested. Now, layer in the international response. Canada is the top export destination for 36 U.S. states. Nearly $2.7 billion U.S. dollars worth of goods and services cross the border daily. That's nearly $1 trillion annually in bilateral trade. About 60% of U.S. crude oil imports come from Canada, as do 85% of electricity imports. Canada is the largest foreign supplier of steel, aluminum, and uranium to the U.S. A 100% tariff on Canadian goods would devastate integrated supply chains across North America. Auto manufacturing operates on just-in-time principles, with parts crossing the border multiple times during production. A single vehicle might have components that cross between U.S., Canadian, and Mexican facilities 4 or 5 times as it progresses from raw materials to finished product. Each crossing would incur tariffs under a 100% regime, making production economically unviable. Earlier this month, Canadian Prime Minister Mark Carney announced a trade agreement with China to remove certain trade barriers and lower tariffs. China cut tariffs on some Canadian agricultural products. Canada reciprocated by increasing quotas for imports of Chinese electric vehicles, applying a tariff rate of 6.1% instead of the 100% tariff Canada had previously imposed in alignment with U.S. policy. Trump initially endorsed this on January 16th, stating it was exactly what Carney should be doing. Then, after Carney's speech at Davos on January 20th, cautioning against economic coercion by superpowers and calling for middle powers to band together, Trump reversed position. By January 24th, he was threatening 100% tariffs if Canada proceeds with the China deal. This isn't policy consistency. This is policy as performance, where economic weapons are deployed, withdrawn, and redeployed based on immediate political calculations rather than strategic economic planning. Even if the 100% Canada tariff never gets implemented, the threat alone forces businesses to consider alternatives and build redundancy, both of which increase costs permanently. Europe experienced its own whiplash. Trump threatened 8 European nations with tariffs over Greenland, causing emergency EU meetings and discussions of retaliatory measures. Then Trump announced his framework deal and suspended the tariffs. European Parliament's Manfred Weber stated that approval of a US-EU trade agreement was not possible given Trump's Greenland threats. The agreement, negotiated last summer, hasn't been finalized. Even though immediate tariffs were suspended, the underlying threat persists. The US-EU trade relationship represents over $1.7 trillion in annual bilateral trade and investment flows. It's the largest economic relationship in the world. European businesses employ hundreds of thousands of Americans. American businesses employ hundreds of thousands of Europeans. Destabilizing this relationship for leverage on Greenland is using a sledgehammer on precision machinery. The broader pattern across 2025 reveals how this plays out at scale. Trump initially announced reciprocal tariffs ranging from 10 to 50% on dozens of trading partners in April 2025. Markets lost approximately $2.5 trillion in value before many rates were walked back. By December 2025, half of all U.S. imports had been exempted from IEEPA tariffs. Agricultural products, including coffee, tea, tropical fruits, cocoa, bananas, oranges, tomatoes, and beef, were exempted after acknowledging domestic demand and lack of production capacity. This created a pattern Wall Street termed TACO, Trump always chickens out. Traders began buying dips, assuming reversals would come. The problem with this pattern is that it works until it doesn't. Each cycle trains market participants to buy the dip, but reversals become harder to execute as political commitments deepen and negotiating partners lose faith in U.S. consistency. Eventually, a threatened tariff doesn't get reversed or gets reversed too late. When that happens, participants conditioned to buy dips discover they've caught a falling knife. Goldman Sachs estimated that tariffs caused inflation to increase by 0.5 percentage point in 2025. Federal Reserve Chair Jerome Powell indicated Trump's tariffs were responsible for the entirety of inflation's rise above the central bank's 2% target, which ended 2025 at 2.7%. Goldman anticipates inflation will increase by 0.3 percentage point in just the first 6 months of 2026. Motor vehicle prices rose 13% in the short run and are projected to remain 5% higher in the long run. That's approximately $6,500 added to the price of an average new car immediately, settling to $20,500 over time. Electrical equipment and consumer electronics saw 17 to 18% short-run price increases. Food prices rose 1.2% short run and remain 1% higher long run. These increases hit households with different intensities, but they're regressive overall. The Tax Policy Center analysis shows the average federal tax rate rising 1.9 percentage points for households in the bottom quintile, compared to 1.4 percentage points for those in the top quintile. Services pick up approximately 1/6 of total tariff burden, even though tariffs aren't directly applied to services, because metals, minerals, and chemical products are inputs for healthcare, professional, and government services. This brings us to the question implicit in the title regarding individual states. If Canada gets threatened with 100% tariffs, and Europe faced 10% tariffs that were suspended but could return, what prevents individual U.S. states from becoming targets of federal economic policy? The question sounds absurd until you consider the constitutional framework and how economic pressure operates. The deeper risk isn't formal tariffs on states, but the fragmentation of economic union through differential treatment. If businesses in states that align politically with federal priorities receive faster permit approvals, preferential contract terms, or regulatory forbearance, while businesses in other states face delays in scrutiny, capital flows accordingly. Over time, this creates economic divergence within the national market. Some states are already more vulnerable based on trade exposure. States bordering Canada or Mexico with integrated manufacturing supply chains face immediate disruption from tariffs. Agricultural states depending on export markets face retaliation from trading partners. The economic pain isn't uniformly distributed. Ontario, a Canadian province, aired an anti-tariff advertisement using words of Ronald Reagan. Trump responded by pledging to increase tariffs on Canadian goods by an additional 10%. If a U.S. state government took similar action, the constitutional question of federal supremacy versus state economic interests would become acute. Historically, economic unions fragment when central authority uses economic policy as a weapon against constituent parts. The Roman Empire's currency debasement created regional economic zones as provinces lost faith in central monetary authority. These aren't perfect parallels, but they illustrate the principle that economic cohesion requires consistent rules applied uniformly. When rules become tools of political favor or punishment, economic integration erodes. What's different now is the velocity and scope of policy shifts combined with explicit linkage between economic measures and geopolitical objectives unrelated to trade fundamentals. Tariffs aren't being used primarily to protect domestic industries. They're being used to pressure Denmark on Greenland, punish Canada for Chinese trade deals, and signal dominance to European allies. When economic policy serves primarily as geopolitical theater, the economic consequences become secondary considerations. Markets can't price geopolitical whim efficiently. We're seeing this play out in corporate behavior. Amazon announced cuts of up to 30,000 jobs in late October 2025. The Organization for Economic Cooperation and Development noted in December that impacts of higher tariff rates have yet to be fully felt in the U.S. economy. They observed a sharp decrease in the value of U.S. imported goods subject to tariffs, suggesting tariffs are affecting demand and will continue to weigh on trade volumes. At the same time, AI investment partially offsets these dynamics. PIMCO estimates AI and related investment contributed roughly 0.5 percentage points to 2025 real U.S. GDP growth. This created wealth effects through stock market returns that supported consumption despite slower real labor income growth below 1%. This creates a bifurcated economy. Households with significant stock market exposure and earnings above approximately $175,000 annually are doing relatively well. The 80% below that line face diminishing prospects. This matters for systemic stability because consumer spending drives roughly 70% of U.S. GDP. If 80% of households are under financial pressure while 20% are thriving, aggregate consumption eventually contracts. Now consider how this interacts with federal debt dynamics. The U.S. debt to GDP ratio continues rising. Tariffs were promoted partially as a revenue source. The Tax Foundation estimates tariffs will raise $2.1 trillion conventionally scored from 2026 through 2035, falling to $1.6 trillion when negative economic effects are incorporated. This doesn't come close to covering proposed tax extensions. The gap gets filled by additional borrowing in a global market where U.S. credibility matters enormously. Foreign holders of U.S. debt include the very countries being targeted with tariffs. If these investors lose confidence or decide to retaliate by reducing Treasury purchases, yields must rise. Higher yields increase federal interest costs, which increases deficits, which requires more borrowing. This is the classic debt spiral dynamic. The international system is responding by fragmenting. Canada and China improved trade relations specifically in response to U.S. tariff pressure. The European Union negotiated a deal with South America's Mercosur bloc, accelerating completion as an alternative to U.S. trade uncertainty. Countries are reducing dependence on U.S. demand and U.S. policy whims. This reduces U.S. leverage over time and accelerates the shift from a unipolar U.S.-centered system to a fragmented multipolar system. The forward-looking question is not whether current policy creates unsustainable conditions. The data clearly shows it does. The question is whether the system finds a new equilibrium through gradual adjustment or reaches a threshold where adjustment happens discontinuously through crisis. Gradual adjustment requires policy reversal or, at minimum, policy stabilization. None of these conditions currently exist or appear likely to develop before further deterioration. This positions us for the discontinuous adjustment scenario, where pressure builds until something breaks and the system reorganizes rapidly around the break.